Good afternoon, George Cavaligos for HFT Bonds. Well, we're banging out these kind of lower risk moves. We sold the uptick this morning on the what I thought was going to be the buyback uptick. It wasn't much of a bounce up, but we got short, somewhere towards the high of the little morning range. Again, the markets are anticipatory. We have been looking at this tendency for these buybacks to lift the market, and it had been somewhere in the 9:15 Central to 10 o'clock Central time where we'd see the highs put in. Occasionally lately, because of the sell-off, we've been seeing that high put in early at 8:30ish Chicago time, in sort of hand in hand with the equity market openings. So I started legging into some shorts around 8:30, thinking maybe I'm a little bit early, maybe we'll get a little bit better of a bounce. But boy, I'm glad I started with those shorts, because the market just started crumbling at that point and never really bounced much. It just kind of drifted lower, covered against the old lows at 28 plus, 29 plus, and was done for the day basically. I threw a comment in the chat room, and I should have paid more attention to it, because I thought we'd seen what looked like a very short term on a 5-minute chart, little 5-wave falling wedge down. Typically those things will bounce, right after you make the 5th wave low, but we never really made a bounce. And I posted in the chat room a comment about the lack of a bounce might be telling us that there just aren't that many shorts in the market at this point. I should have put a short back on at that point, but man, guys, I'm still struggling health-wise here. It's been the most ridiculous 2 weeks of flu that I can recall ever. And if it drags on much longer, my wife's going to ship me to the doctor real soon. So keep your fingers crossed. But the FOMC minutes came out later this afternoon. I don't get what these guys are saying. They're sounding like they're real Fed governor, or not Fed governors, like real central bankers now. 2 weeks ago they're talking about doing QE forever, and maybe we'll do more, and it'll go on, and we'll never stop until the unemployment rate gets to 6.5%, and maybe not even then. And then the FOMC minutes come out, and these guys are sounding like, oh no, maybe we did the wrong thing. Oh, there could be some consequences from this. Maybe we should stop earlier. Bullshit. They're not going to stop. Markets traded off as they announced QE4, thinking they're priming the pump when the pump don't need any more priming. We're risking inflation. God knows what other consequences are to all this QE. We've never seen anything like this before in history. So we'll see. This whole methinks thou dost protest too much here. I don't believe them for a minute that they're going to stop this stuff. I wouldn't be surprised. We'll go a quarter. Like I said in the Q1 preview the other day, I think we're going to go for a quarter at least. We've not even today was the first QE4 purchase, and they're already backing off on it. It's bullshit. I'm sorry about the language, but that's all it is. It's bullshit. Well, the market sold off hard on it, and caught me kind of surprised. I was a bit surprised by it. We went down. We're getting close to some levels. We took out in the 10-year the lows from September at 131.22 area. We matched the lows in the bonds at 144.15. Now, which wave count do you want to look at? I can give you a couple different ones here. As we meet these objectives, you want to cover shorts, but it doesn't mean to get long yet. And until I see some kind of bullish response to one of these levels, the bonds got down to 144.15. Did they bounce? Yeah, a little bit, half a point, but then they gave it all right back. The 10-year, we've never even really bounced. I did take off my a large percentage of that TBF trade today. I think I was long from 28.85 and 29.15. I sold a chunk at 30.01 today, And if the bonds get down to 143.25 tomorrow, that's the C equals A, I'll be out of that position completely and looking maybe to see how we react to these levels. You know, because we have these objectives, that doesn't mean that the market should immediately turn there at that level. We could go further. This thing could extend. We could be going down in a third wave and not in a C wave. You know, I threw up the most likely probability that this move down is a C wave of a big corrective pattern that we have been in since the early summer of last year in 2012 when the highs were put in. What if it's something else? What if it's the beginning of a bear market and we've seen 1, 2 and now we're going down in 3? The fact that we left that gap 2 days ago and we haven't even gotten back towards that gap is intimating that this could be the start of something even bigger. You know, gap moves like that typically occur in 3-wave patterns where the market gaps down initially. That's your breakaway gap. Then you'll have another gap. That's your pattern gap. And then the third gap is your exhaustion gap. And my charts are 24-hour charts, so gaps on a 24-hour chart are very key. You know, if you look at a day session only chart, there's gaps all over the place. I think, you know, if you see gaps on 24-hour charts, boy, you better sit up and take notice and be ready for big moves here. If that's the first gap down in a third wave, we got a lot of downside potential here. Then we're looking at, you know, previous fourth wave corrective moves. If you look at the 10-year, the previous fourth wave of 1 less degree is either at 127.23 or 127.06. That's another, what, 4 or 5 handles? That's the 10-year. The bond, previous fourth wave of 1 less degree on my charts is all the way down at 136.5. That's some serious moves there, guys. This should be an interesting year. Let's keep our fingers crossed. We've had a couple good days to start the year. You know, we've only traded a little bit and we've caught some, you know, large percentage of these moves. I, you know, wish I would have kept more on, but you know, I'm not trading through numbers. I'm not, you know, taking headline risks at this point. We're putting on low risk trades, or no trades low risk. We're putting on lower risk trades and, you know, stealing or, you know, snatching our gains and being done and moving on. Tomorrow's Friday. It's a non-farm payroll number. I've only got a little bit of that TBF position on. And I've got very little in terms, I have no futures positions on right now. So I want to take a look at this thing and see what kind of a bounce we can get out of this. And if we get a decent bounce, I'll try to put some shorts back on. There is no buyback tomorrow. The Fed starts up the buybacks next week, Monday, every day. I think they start out kind of small. So again, we'll have those opportunities. But you know, the lack of bounces here is really a concern to me. The fact that we're not bouncing, and you know, those things tell me that there aren't very many shorts in the market. Next week you also have an auction process, 3s, 10s, and 30s. I don't think the dealers have a big short hedge on for those auctions yet. You know, I think we did see some of that later in the day today. I guarantee you they did some hedging. I just don't know if they hedged enough. So we'll take a look at this thing as we move forward here. I want to try and sell rallies. Any kind of a bounce back up towards the old lows at 131.28, 29 area on the 10-year. And God, what was the old low on the bonds here? Can we even look at that right now? 145.19. We're trading 144.19 right now. That might be too much to look for. I might want to look at the bar, the low from yesterday at 145.13 as my first shot on the short side there. That might be too much to look for even. Have to just kind of play it by ear. Want to sell rallies. That's the plan moving forward here. Again, highlight 143.25 on the downside. On the bonds is C equals A. And on the 10-year, 130.18 to 20 area, depending on which moves you're looking at, that's your C equals A targets down there. That's a long way off still. We've got old lows in the 10-year at 131.09, 131.06. I think maybe that's kind of a target you want to keep in mind here on the 10-year. I think it's more likely in the bonds to see 143.25. That's only another half point lower. And if that happens, we'll see that 131.06.09 level on the 10-year. Have a great night. Hope to see you in the webinar at 4 p.m.